Now, here is Ticky Fullerton on Your Money.
Hello, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Lots to talk about today. Coming up, power in the hands of industry super. What are they going to do with it? Our special interview with the Chief Executive of Australian Super on the future of it all and how big things can grow. Growth soars at ING, over 400,000 new accounts, and all without branches. Leo Shanahan talks with ING's Uday Sareen. And the 737 MAX crisis hits Boeing hard, with shares tumbling as more countries ground fleets. Aviation analyst Steve Creedy looks at the impact on the manufacturer, again with Leo. And mayhem in Britain. The Parliament votes down Prime Minister Theresa May's New Deal. Where will we be by the weekend? The Australian British Chamber of Commerce, David McCredie, joins me from Canberra. Well, let's kick off with industry super, or not-for-profit super, as they prefer to be called. It's the new black emerging from the Royal Commission as the place to invest. Industry super's statesman is undoubtedly Ian Silk, CEO of Australian Super. In a landmark speech at the CMSF conference today, Ian Silk warned against hubris and complacency, dished out blunt pointers to colleagues on how to keep member first their priority, had a go at the self-managed super fund sector, and called for a new, bold approach to investing. I caught up with him on the sidelines. Ian Silk, thank you so much for joining me. The future of our super. You've got 145 billion of it, I think, in your hands at Aussie Super. Are we in good hands?
I think we're in good hands, but more importantly, independent observers like the Productivity Commission have concluded as such. Their report last year said that the majority of Australians are in strong performing funds, and that's the critical issue. Are people in strong performing funds? And they said the majority of people are.
I think you call in your speech, which was a really interesting speech, I thought, you said it's no time for hubris or complacency among the industry, the super funds, which came out of the Royal Commission extremely well, one has to say. Your mantra is, from little things, big things grow. Now, that wasn't always the case, though, for some of the inactive accounts. And I just wondered, given the fees that were eaten in there, how that compares with the fee for no service scandal in size. Well,
it's a quite different position, Ticky, because the people who were members of the funds were getting a range of services. They were receiving a range of services. But I think the point that you make overall has some validity, and that's why we've supported the moves announced by the federal government in the May 2018 budget to transfer small inactive accounts to the ATO. And indeed, we're looking to do that to an eligible rollover fund or to the ATO ahead of time.
OK. Looking forward, you've talked about the good returns that profit for member funds have managed to achieve, particularly compared to the retail funds. You say the investment outlook, though, is looking tougher. How do you manage the expectations of superannuants, particularly when you finally get to draw down your super? It all depends what day or year it is.
Well, it depends what day or year it is on your final day, but superannuation is a multi-decade investment. Most people will have money saved for up to 40 years or so whilst they're working, and then for another 20, 30, hopefully another 40 years in retirement. So the actual day of retirement is not really the issue. But the point I was making today is that we've had a pretty benign investment environment for the last decade or so. Most super funds, indeed most investors, have made pretty good money over the last decade, but the investment outlook for the future is looking more challenging. And so the particular challenge for super funds is to try and ensure we make a good fist of investing in a more challenging environment.
Yeah, key to that, presumably, is having the right people, making the right allocations in terms of your investments. You've had quite a go at the self-managed super fund sector. Why?
Well, the self-managed super fund sector is pretty widely regarded as an opaque sort of sector. Hard data that can be rigorously interpreted is pretty hard to come by. The Productivity Commission had a go at it, and they concluded that most self-managed super funds under $500,000 perform, quote, significantly worse, unquote, than industry funds and even retail funds. So that's a concern, because there's a large number of the 700-odd thousand self-managed super funds that are under $500,000. ASIC has done a review of the self-managed fund sector. They say that 31% of self-managed super fund owners or managers don't know that they're required to have an investment strategy, and a much higher percentage don't have an investment strategy. So these are pretty fundamental elements of our compulsory super system. You don't know you need an investment strategy, and then the large number under $500,000 are performing poorly. It's a sector that needs the spotlight shone on it. The government, for reasons best known to themselves, excluded the self-managed fund sector from the Royal Commission. I'm simply saying, let's have a good look at the sector. If it stands up, terrific. But I'm sure we'll find areas where it can be improved.
Yes, no, you make some very good points there, but cynics might say also this is another grab for market share.
Cynics might say that, but the point is, if a merit-based inquiry says that the self-managed fund sector is serving the best interests of the members of those funds rather than agents responsible for managing those funds, terrific. But there's enough data produced by credible government agencies to suggest that it warrants real scrutiny, and I suspect there'll be real changes if that inquiry occurs.
Ian, we've seen what almost absolute power did in the banking sector. The power in terms of money is shifting to super and industry super in particular. If you think of Member First, which obviously you're very much driving that forward, think of Ian Silk, Greg Combay, Heather Ridout, Brett Himbrey, even people like Deanne Stewart, new people, sensible people with integrity, acknowledged. And then you think, well, hang on a minute, what's to stop someone, though, down the track with the ideology of perhaps more like a John Sector from having one of the roles that you have?
Well, Ticky, the point about industry funds is that they've been around, or the modern generation of industry funds that started in the 1980s have been around for 30 years. They've had an exceptional run of investment performance and an exceptional run of performance more generally. We accept that that is just the foundation that's established as of today. Tomorrow is no guarantee about the past, but the governance structures that have facilitated the achievement of those investment performance are the governance structures that we're looking to maintain. And I do think that culture and this laser-like focus on members does start at board level. There's no prospect that the board structures of industry funds are going to be wholly turned on their head, even though the previous minister suggested that should occur. They are going to continue to be focused on members. And if they don't, and if the funds lose their way, and if the funds become pale shadows of the retail sector, then we'll find that we'll lose a lot of members. They'll go to other better performing funds, which is what, in that unlikely event, they should do. But I'm very confident that industry funds are going to maintain their strong performance into the future.
Yeah, just on industrial relations, be a lot of people talking about it. You've described it as quite a lot of hysteria over the last few days, some of the commentary. But there are some tricky areas. I spoke to your chair, Heather Ridout, about union pressure on your board for wage hikes. Should the investment decisions that you and, say, Mark Delaney make be influenced by whether companies are prepared to deliver wage hikes?
Ticky, the critical issue here, the fundamental point that has governed and been responsible for the success of industry funds and their investment performance has been this laser-like focus on members and delivering strong investment performance. And that will continue to be our approach in the future. There is a question, there is a debate about whether environmental, social and governance issues, so-called ESG issues, should factor into investment decision-making. Our view is that they should, because they're legitimate factors shaping the long-term value of businesses and companies. And to ignore them is to ignore factors that are shaping, ultimately, the investment performance of the fund that's invested in those organisations.
But you'd put wealth inequality
ESG,
and wages up there within ESG.
Well, wealth inequality and wages, not strictly speaking, but how a company manages its workforce. Is it responsible for chronic underpayment of its workforce? These are issues that go to not just the social licence to operate of a company, but to its long-term valuation. You don't have to look very far back in the last couple of years. There's half a dozen or so examples of companies that have lost a lot of value and therefore ultimately members of super funds have lost money as a result of poor labour practices. We're not saying we're only going to invest in companies that provide very generous wage increases, but we are going to say companies need to respect their workforce, not just because a respected workforce is going to be a more productive one, but ultimately there are going to be financial implications for those companies that treat their workers poorly.
Yep. You have talked today about being different and bolder in terms of delivering growth. An exciting part of this, I would imagine, is looking at private equity, taking shares in private equity and teaming up with private equity. You've also said that industry funds should continue to be the sort of investor that business want on their share register. Now, I'm just wondering whether Healthscope and Navitas would necessarily agree with that. Should corporate boards be worried about companies like Aussie Super on their share register now?
Well, corporate boards are voting with their feet about that, Ticky. We continue to receive approaches from companies seeking large-scale private investment, and they say, and they're very open about this, they want organisations on their register that have a long-term view. There are plenty of organisations that bemoan and lament the short-term horizon of many investors in the Australian Stock Exchange. They look at a fund like Australian Super, which is growing significant inflows into the fund, and that has a long-term investment horizon, and that's the sort of organisation that they want on their register. And
but it does present conflicts. Have you got your head around the different conflicts that present themselves to you?
Look, I believe so. Our interest is ultimately the members of the fund. And we believe that to invest with the long-term horizon is to serve their interests. Now, the two instances you referred to, we're looking to buy at the best price for our members. We make no apologies for that. That's what they expect us to do.
I must ask you about Wesfarmers. You're invested in Wesfarmers. Now, Ian, this week, Kmart did a deal with the union to force 32,000 Kmart workers, mostly young and casual, think women, I guess, to use industry super fund Rest. Now, Rest is not even a top performer on the short-term ratings. The Royal Commission says this should be illegal. What's your position?
Well, as you say, Rest is not a top performer in the short term, but it's a very strong performer in the long term. As a general proposition, I believe all workers should be able to choose their own superannuation fund. Currently, workers covered by awards can choose a fund. Workers covered by some enterprise agreements cannot. And there may be instances in what I would hope would be exceptional circumstances where that's justified, if the previous history of the employer warrants that sort of approach. But as a general proposition, where employers behave well, then I think all workers, should be able to choose their superannuation fund if they want to opt out of the default fund.
Exactly. OK, now, finally, you're growing on the savings side, as we know. Ian, at what point does scale become a disadvantage? Because you're obviously going to be investing more and more offshore. All this money presumably eventually has to come back as well. Do you worry about how the Aussie dollar exchange rate works and all that sort of stuff? These are big decisions going forward, aren't they? They
are big decisions, Ticky. So a couple of points. First of all, we are investing more offshore in our equities portfolio. We've got about 23% in Australian equities and about 31% currently in global equities. 3 or 4 years ago, it was about 50-50, and years prior to that, Australian equities dominated the equities portfolio. So that's one issue. We're spending or investing more of the money both in equities and other asset classes offshore. But the other point, the key point you make about can we be too big, we do a lot of travel to overseas pension funds, big funds, global wealth funds, global sovereign wealth funds. Many of them are multiples the size of Australian super, and they're producing terrific results. So we don't have a concern that we're approaching a point where diseconomies of scale kick in. Right. If we got to that point, we would act on it. We would close the fund to new members, because the whole issue is to run the fund for the benefit of members, not to build a big investment platform for the sake of it. But for the moment, we're continuing to improve our investment performance together with the growth in the fund's assets. So we're using the economies of scale that growth has provided to produce better outcomes for members.
Ian Silk, so interesting to talk to you. Thank you very much.
Thanks very much, Ticky.
And after the break, ING Australia's customer base soars. We'll hear from CEO Uday Sareen next.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, ING today released its annual results. Statutory net profit after tax coming in at $401 million, up 15% on the previous year. The earnings came with record customer growth for the digital-only bank, with a 57% lift in primary customers. It's a good bank news story, isn't it? For more on those results and what the bank makes of a delicate situation now around mortgage broking commission, Your Money's chief business reporter Leo Shanahan spoke with ING Australia CEO Uday Sareen earlier.
Uday Sareen, thanks so much for joining us.
Oh, thanks for having me.
Now, congratulations. Good results in a tough environment for banks generally. Up 15%, 400 million in the calendar year 2018. But it's your new customers, I think, that are really impressive. Some 400,000 new customers. Are you the best or greatest beneficiary of the Banking Royal Commission?
You know, we've had continuous strong momentum in customer acquisition now for over the past 3 to 4 years. We've crossed 2 million customers now in Australia, and while we acquired 400,000 last year, but I would say about a third of these 2 million we've actually acquired over the last 3 years. So we're continuing to see good traction as we drive towards more and more primary customers, because I think that that's a key metric for us. Of the 2 million, 645,000 customers, of them treat us as their main primary bank account. And that strategy has now, I think that's working for us over the last 4 to 5 years.
Yeah, more on that in a moment. But I did want to ask you, it's the first time I've spoken to you since the Banking Royal Commission report was handed down. What were your thoughts on the process, and did the recommendations surprise you? Do you think they went far enough?
I think, clearly what's come into sharper focus is, at the end of the day, it's good customer outcomes, and I think that's what's going to, from both from an industry perspective and from a customer's perspective, those are going to be the good outcomes. And in terms of the recommendations, clearly we're supportive as we move towards, from the recommendation stage to the legislation stage, and we will see. I think both sides of politics have come out in support of the recommendations, and I'm pretty sure that the end outcome for the industry and for customers will be good.
Okay, one recommendation was around mortgage brokers. Now, ING have a fairly high reliance on mortgage brokers because of the fact that you don't have any, I suppose, concrete buildings here in Australia. Now, both sides of politics seem to have backed off that recommendation, i.e. in commissions, and now the coalition backing off trailing commissions altogether. Your thoughts on that, and whether commissions should stay within the Australian market? We've
been working with brokers now for 20 years. I mean, we actually complete 20 years this year in Australia. And 6 of 10 Australians actually acquire their home loan through a broker. So we believe it's a core and central part of the way the mortgage business gets done. And in our view, I think it's really important to have a sustainable and competitive broker channel. Now, clearly, as we see what and how and what gets into legislation, I think it's really important from our perspective that a sustainable broker channel is here to stay. And if indeed there are some changes in terms of the remuneration framework. We're actively working with our stakeholders and key partners to ensure that we have a sustainable broker channel, because I think that's true value that Australian consumers get from the channel. And they're embedded in the community and they bring that value. We've been working with them for 20 years, and I think it's really important that there is a sustainable broker channel in Australia.
There's a lot of talk about the Dutch model. You, of course, are a Dutch bank. Does that Dutch model, do you end up actually paying less? Do customers actually end up paying less? What's the difference there, do you think?
Well, I think it's it's a different model in a different jurisdiction. There are some differences in the way, for example, in the Dutch model, sure, it's the user that pays, but then whether a consumer walks into a bank branch or goes to a broker, it is the same cost. So to that effect, it is channel neutral. And it's tax deductible. So there are some fundamental differences. I think from our perspective, 60% of Australians use brokers. We as ING are happy to pay brokers for that service. Lenders have always paid brokers, and I think sure, we support the duty of care, and I think it's in the interest of the broker to act for customers, which they have been doing. And it's important that as we have those changes, we have a sustainable broker channel. Okay, well, on the point about home loans are a big part of your book now. How concerned are you about the downturn in the housing market in Australia, and how much responsibility do banks have to continue to supply good credit? Leo, we've been about 80-20 in our mix on mortgages between owner-occupier and an investor. And that hasn't changed for us. Even if you see the numbers last year, we grew our mortgage book by just a tad below 9%, which was faster than in industry. So we gained share. And there are certain segments there within owner-occupier in terms of first home buyers, which we're making some good traction. That kind of aligns with our customer base. And sure, if you look at, and there are multiple different markets in Australia, even even with Sydney, there are multiple markets. So sure, if you look at the last 12 months stats, dwelling prices are down 10% in Sydney and Melbourne. But then over the last 7-8 years, they're still up 50-60%. So we continue to watch that closely. It is a key focus for us. But in our segment, while industry has traditionally been 60-40, and that's the kind of changing between owner-occupier and investor, but we see our share steady, and of course in terms of absolute growth we're getting some good traction. Is it harder to get a loan at ING than it would have been, say, a year ago? Well, our approval rates have not come off. We're actually doing more loans than industry and growing at a faster clip. So my short answer would say no. Okay, now a big part of your bank in Australia is that you have no branches, no bricks and mortar, and this, what some people said years ago was a bit crazy, is now turned into a real advantage for you, because banks are often trying to get rid of this cost. Is there any thought to going into any kind of branch, and how much of a benefit is it having no branches in Australia? I think mobile has been a game changer. Today, 99% of all customer interactions, and we do close to 700,000 a day with our customers, 99% of that is digital. And 1% is the 5,000-6,000 phone calls that we get. But of the 99%, 70% is mobile through the app. And these numbers used to be roughly 50% of that level just about 3 to 4 years back. So clearly, we're seeing traction there. That's increasingly how more and more Australians deal with their banking, and not just the millennials. I mean, baby boomers have been dealing with the internet now for over 2 decades. So clearly, from our perspective, offering convenience and offering mobile and increasingly delivering products and services through these channels, I think is key. And that is differentiating, and it is a competitive advantage for us. Now, you talk about the growth in primary customers, over 600,000 primary customers. How do you define a primary customer for ING as their being their primary bank? So the industry definition is MFI, right? Yeah. In ING, we have, and different banks have their own definitions. So the way we call our primary customers is if you have an Orange Everyday transaction account with us, and at least your salary or $1,000 coming in every month, and you do a minimum number of transactions every month, Plus, you have another product with us in savings or mortgages, and that is our definition of primary, which used to be sub 100,000 even in 2015. And fair to say that when we launched in 99, we had savings and mortgages and probably were a secondary bank. But now we're seeing significant traction there. Over the last 2 years, we've doubled that number, and I think we can get to 1 million primary customers by 2020.
Yeah, that's the aim, 1 million, right?
Yep, that's the million. And that's a reasonable, but still just 1 million, right?
All right. Now, you've had a lot of growth in your basic transaction account, as you said, credit cards. You've moved into areas like personal loans. There's talk of some new products, maybe a trading platform coming up. Do you risk overexpanding in this environment where banks seem to be going back to basics?
I mean, we, at the end of the day, had, just till about 3 years back, from a consumer perspective, on lending, 90% of our loan book was just mortgages. We've launched personal loans last year. We launched a credit card year before last, and it was only for existing customers. Last year, we opened it up to new to bank customers. So these are fairly basic consumer products. And like I said, our customers were asking us for these products, given our high advocacy. So it's completing the product suite from that perspective. So to have a retail consumer offering with loans, which is a need that that customers have, and mortgages is not really overextending. But we're very conscious that we don't want to go out there and rush into some of these products, and want to make sure that we continue to offer them based on the needs that customers have, and build in the product design true customer needs. I think that's key.
No, it's a challenging environment for banks in Australia, but also globally at the moment. I understand, in the ING group, you're grouped within a lot of kind of secondary European countries that aren't the primary market outside of Holland and Belgium. How does Australia rate? How does its growth rate in comparison to those other European countries?
I think we're doing well.
Yeah.
We're part of. So of course we have our home markets, and we're part of what is known as the challenger and growth markets. And which is Germany, France, Spain, Italy, the Czech Republic, Austria, and Australia, where the business model is quite similar. Which is essentially these are former ING Direct countries, and we have savings and mortgages, and now so very similar kind of paths in terms of a life stage. And in terms of how we're doing, I think in terms of if I was to pick one metric, just in terms of new customers and primary bank growth, we would be right at the top, if not the top, in terms of just traction and momentum. Okay, well done, Uday Sareen. Thanks so much for joining us. Thanks, Leo.
After the break, what can Australian industry learn from innovation king John Donahoe? My interview with the CEO of Servicenow next.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Now, what sector does the world's most innovative company, according to Forbes, operate in? Well, the cloud, of course. NASDAQ-listed Servicenow boasts the fastest growth of any cloud unicorn in its mission to make life in the office easier. From the US, it is operating globally, although interestingly not in China. While the US-China trade war is centered around IP and tech and IT, it's about products, not services, which is something that I hadn't quite appreciated. For US software companies, it's a bit of a no-go zone, but plenty of business elsewhere. Servicenow founder and chief John Donahoe, a former CEO of eBay, was in town today. John Donahoe, nice to talk to you again. Now, you're still the most innovative company in the world, according to Forbes. Just remind us of that central innovation.
Well, basically what's happening all around the world is companies are embracing digital transformation. Now, that's a big word, but what that means is that over the last 10 years, mobile devices have transformed our lives at home. They take what's complex in our personal lives and make things simple and easy, intuitive. Technology adds value to our lives at home. But by and large, technology doesn't really make our lives at work simple, easy, and intuitive.
Well, yeah, I mean, our big four banks have really wrestled, I think, with keeping up with the digital age.
which is exactly why every company in every industry around the world is embracing digital transformation. And what that means is they want to digitally connect with their customers, provide a better digital experience for their employees, and use digital technology to try to drive simplicity and automation so that they can focus their scarce talent and capital on innovating for their customers. And Servicenow has become a core, essential part of a digital transformation agenda for almost every company.
So there are other competitors in your space, I think. Just what is it about your product that differentiates?
Well, there's really not that many additional competitors. What's happening is 75% of the Fortune 500, 60% of the ASX listed companies are embracing some of the core platforms of the future. Servicenow is one of those, Salesforce, Workday, Adobe, Microsoft Office 365. These are all born in the cloud platforms, modern technology that enable the kind of great user experiences at work that we're used to getting at home.
And John, why is Australia important?
Well, it's actually a very important market. And in my prior lives, I learned that when I was leading eBay, when I was leading Bain prior to that. Because Australia's got great companies, great multinational companies, great companies in multiple industries, companies that matter. And yet the market's small enough that these companies can get their hands around their operations. And so we view Australia as a really important market for Servicenow, both for our customers and for the talent. So I've had the chance over the last couple of days to meet with many of the leading companies here in Australia as they embrace their digital transformation agenda. And what's distinct about Australia is you talk to a C-suite executive and they can get their hands around their company. They're driving change at an aggressive pace. And so I think we look to Australia to be a place of innovation for Servicenow because Australian clients are some of the most innovative companies in the world.
So just looking at our big four banks, for example, these are big decisions in terms of capital licks. What drives their decision from a client point of view, do you think?
Well, every CIO, Chief Information Officer, Chief Technology Officer is trying to figure out what is the modern tech stack of the future? What is the combination of platforms that will enable them to deliver great experiences at work and drive productivity? And Servicenow is one of those. And so if you think about what we do, say 30 to 40% of our lives at work are repetitive, redundant, menial tasks. In fact, we just did a survey in Australia. People said that 42% of their time is menial tasks. What Servicenow does is automate those so that we can work, not spend our time doing redundant, repetitive, menial things, but actually focus our time and energy on doing value-added activities.
So these menial things are things like?
Resetting your email password, employee onboarding, all sorts of things. Think in your home life that we used to say when we had to call a taxi or get a ride, we have to pick up the phone, go out on the street, hail something. Now we just press a button on our app or on our mobile phone, right? To either use Uber or a taxi service. The same thing's true at work. So instead of when you have a problem with your laptop or a printer or your email, instead of picking up the phone and calling IT, now you can just do it on an app.
Well, interestingly, it's gone through to the mobile now, hasn't it? Absolutely.
Mobile is how we live our lives at home, and increasingly mobile will be how we live our lives at work. And we're thrilled in that we released last week our latest release of our software. We release our software every 6 months, much like the iPhone updates your software constantly. In the enterprise environment, Servicenow releases software every 6 months, and in that software we now have native consumer-grade mobile experiences. So that Australian.
What does that mean?
So that means that an Australian, I was with some of the agencies in New South Wales yesterday. They want to build citizen experiences. So they want to build citizen experiences so that citizens can get their services on a mobile device, but they don't have the capacity to hire mobile developers. So now Servicenow, when you have the Servicenow platform, those mobile capabilities are such that someone with no code or low code can configure a mobile application at work for their employees, for their customers, or in that case, for their citizens.
And you can, as a government client, have different companies working in different parts of the government. I think I was down the other day talking to Microsoft about the New South Wales government on the finance department side.
Absolutely. As I said earlier, a modern tech stack, what I hear all around the world is that companies want to embrace 4 to 6 strategic platforms. Typically it's Salesforce, Workday, Servicenow, Adobe, Office 365, Microsoft, maybe SAP at their supply chain.
Is it good to have that variety when you're a big client, do you think?
Well, it's an essential, because they each do different and complementary things. Think about it in your home life. You have 4 to 6 strategic apps you use. You use PayPal, eBay, I hope, Uber, maybe Amazon, maybe other ones. Yes. You have 4 to 6 ones you use time and time again. The same thing's true at work. They do different things at home, and these things do different but complementary things at work. And working together, that's the way we can transform how work gets done.
And just give me an example of the sort of innovation that you're looking at the moment.
Servicenow has worked with Deloitte to build an experience that enhances the quality of the doctors, nurses, and patients in the following way. One of the biggest challenges that a doctor or nurse has when they go in to serve a patient is both their hands are full. And so but often they need to sort of make a request. So they may need to request they want to bring new meds in, or that the bed needs to be changed. But they don't know how to do that. Well, Deloitte, working with Servicenow, has created a voice-activated AI tool so that the doctor or nurse or the patient themselves can say, please come change my bed. It's recognized and immediately routed to the right person to come do that, or please bring new meds in. And so it's a great case of using technology to enhance both responsiveness for the patient, but also to allow the doctors and nurses to do less administrative work and focus more of their attention on doing what they want to do, which is serving their patients.
And John, if you do adopt one of your systems, we always think we're vulnerable to hacking as an individual. How do you deal with a threat, a hacking threat in the office workplace?
Well, here's what companies and increasingly governments and educational institutions are realizing all over the world. Cloud is safer than on-premise. And so they're embracing cloud because it's actually safer. So many of the national security agencies are embracing cloud, many of the banks all over the world, healthcare organizations, because cloud is actually safer.
Even though cloud is, we all know, is just, you know, a group of systems sitting somewhere else other than where your place of work is.
But they're being run and led by the best security experts in the world. So at Servicenow, we have the best security experts in the world. We can attract them, we can retain them. We've architected our data centers so that we have redundancy, so that one company's data is never shared with another. And so in many ways, cloud is the safest way to go. And you see that with the growth in the cloud companies. Companies, governments, and industries are recognizing that all over the world.
And from an investor's point of view, where are you looking at growth now? What drives your growth?
Well, in simplest terms, what we find is a company brings Servicenow in, often in the IT space, and then starts using Servicenow for a wider use cases across the organization. So maybe using Servicenow for IT use cases to help them become a modern IT shop. The whole end-to-end employee experience, which gets to the user experience, whether it's employee onboarding or all the different ways that employees want to engage with technology at work. Servicenow enables that. And then also with end customers. Customers want to get their problems resolved themselves. They want to use self-help wherever possible in their work life, just like we have in our home life.
So that's where you see the growth coming from a business point of view? All
three of those major areas are fueling our growth, and our growth, we're blessed with very strong growth. We're the fastest growing enterprise software company, over $1 billion in the world, and that's just simply driven by the fact that this digital transformation is not...
And key markets?
And in markets all over the world. I mean, the digital transformation cloud, that's happening all over the world. It's happening in Australia. It's happening in all the major markets and increasingly the developing markets over the world.
And you're impacted by China at all?
China is one market we don't participate in, for the simple reason that the Chinese government sort of governs software fairly tightly.
But you must be happy that you're well out of there at the moment.
Yes, we are. There's plenty of growth elsewhere all throughout the world.
John Donahoe, very nice to talk again. Thank you.
Great. Thank you, Ticky.
The European Union has suspended Boeing 737 MAX flights joining Australia and a wave of other countries grounding the model. The Australian Civil Aviation Safety Authority temporarily suspended the operation of the aircraft after 157 passengers and crew on board died in an Ethiopian Airlines crash. It's the second fatal accident involving the model in 6 months. Countries including China, India and Indonesia have also grounded the jets, but the United States aviation regulator maintains the aircraft are safe to fly. That's put it at odds with the US President Donald Trump, who has taken to Twitter, writing, "Airplanes are becoming far too complex to fly. Pilots are no longer needed, but rather computer scientists from MIT. I see it all the time in many products, always seeking to go one unnecessary step further, when often old and simpler is far better." Well, it's worth noting that today we saw New Zealand, Fiji, Bermuda and the UAE also suspend or ban the 737s. Boeing stocks have plunged over 11% since Friday in the US. Remember, they're a big company, the most since 9/11. Should we expect a recovery for the aerospace company? Leo Shanahan spoke with Airline Ratings Editor and former aviation editor of the Australian, Steve Creedy, earlier.
Steve Creedy, thanks so much for joining us.
Yeah, thanks, Leo.
Now, look, I wanted to start off with the latest into the Ethiopian Airlines disaster, because obviously that's what has caused this widespread concern around the Boeing 737 MAX. So what is the latest you're hearing in regards to this investigation?
Sure. So what's happened overnight, basically, is the European regulatory authorities have put the planes on the ground and said they can't fly to, from or within Europe. And then the US Federal Aviation Administration, which is the regulatory authority in the US, has come out and said, well, you know, that's fine, but we've had a look at this plane over a period of time and we can't find, you know, any problems with it at this stage, and we don't have any reason to put it on the ground. But if something does emerge, we will. There's also been a couple of comments by the CEO of Ethiopian Airlines where he originally said the pilots had told air traffic controllers that there were technical difficulties with the plane. He's now expanded on that a little bit and said it was to do with the flight control system.
Yes, well, on that point, now obviously this was the same plane that crashed, the Lion Air 737 MAX in October last year, killing all passengers on board. Now, both those crashes occurred minutes after takeoff. So obviously similarities there. What are the technical, I suppose, parallels that investigators would be looking at investigating in these two crashes with this aircraft?
Look, there are some similarities in the fact, as you point out, that basically they crashed shortly after takeoff. There was also some variance in the vertical speed of the aircraft in both cases. This has been pointed out more by commentators than by the investigation team itself, which hasn't really said anything at this stage. At this point, it's basically, I mean, they'll be looking at all those factors, but at this stage, there is basically no hard evidence to say that the two are linked. That may emerge, but at this point, there isn't. What they do have is the cockpit voice recorder and the flight data recorder, the so-called black boxes, and both of those will give us crucial information on what happened to that plane.
Now, obviously, Australia, as you mentioned, overnight has moved to ground this plane, even though it's not active yet here, but Virgin planning on ordering. Europe, Indonesia, China, among much of the other powers in the world that have grounded this plane now. How long do you think it is before this plane is just grounded, full stop, and what are the implications for Boeing?
Well, look, I mean, at the moment, as I said, the US Federal Aviation Administration is resisting that. I think the Canadians are still flying it as well. If it's grounded full stop, I mean, look, this has happened to Boeing before. It happened with the 787 with the battery problem. They'll go in, they'll fix it. if there is a problem, and you know, they'll get them flying again. But in the short term, of course, you know, it's had huge reputational damage. It's also hit their share price quite heavily. Yeah. I mean, it was down more than 5% on Monday. It was down another 6% on plus on Tuesday, and then that's had a rolling impact on the Dow. And it's got to the point where even Donald Trump has sort of weighed into the debate, saying that, you know, he thinks things are getting too complicated and simple and older things are better. But I mean, ultimately, you know, Boeing will fix this, whatever it is, because that's what they do. I mean, you know, they take a great pride in their aircraft, and they basically, you know, if there's a problem, they work at it until they get a fix. Yeah.
You mentioned that the US is still allowing it. The Canadians seem to be a bit 50-50, but do you think this plane would be in the air if it wasn't being made by an American company?
Yes, well, it's hard to say. I mean, one thing I would say is that the regulator that has had most to do with the plane and that has had the closest look at the problems that were raised during the Lion Air crash is the Federal Aviation Administration, US Federal Aviation Administration. So I would imagine there's a bit of pressure there to basically, you know, not let the home team down, but in the same instance, I mean, they're a reputable organisation, and they are the ones that have had the closest look at it. And they have actually said that the other regulators that have grounded the planers have not provided them with any information which suggests there's something that they know that the FAA doesn't. So, you know.
Now, in Australia, to return to Australia for a moment, obviously Virgin had ordered about, was it about 30 of these planes worth of $172 million. The moment they seem to be still vaguely committed to that, but it seems to be wagering by the, you know, by the day. The language now is that there are no 737 MAX 8 in our fleet, and they're monitoring the situation. Do you think it's likely now that Virgin will dump that order, and what are the implications then for Virgin and for Boeing? How does that work in money that's been paid, for instance? Look,
I think it would be unusual for Virgin to dump it at this late stage. You know, they are leaving their options open, I guess, in case there is some kind of, you know, shock horror problem with the plane. I doubt that there is. They have softened their language, you're right. But I suspect that they will probably go ahead with the order.
All right. So what do Boeing then, in the long term, have tied up in this plane? How important is it to its strategy over the next few years? Was it a significant part of really what's propelling them forward at the moment? No pun intended.
Yeah. Look, the 737 is the workhorse, you know, of the Boeing fleet. It's their moneymaker. And the 737 MAX has been, you know, tremendously successful in terms of getting orders and things like that. So any you know, anything that tarnishes its reputation is not good for the company. But as I said previously, I mean, Boeing has faced these sorts of things before, and they will find if there is a problem, they will find a fix for it. I mean, and the problem at the moment is that we don't actually know what happened with the Ethiopian plane. We have a much better idea of what happened with the Lion Air plane, but we don't with the Ethiopian plane. So it's hard to say, you know, whether there's anything that Boeing particularly needs to do other than the things that it's doing to address the Lion Air issues.
All right, Steve Creedy, thanks so much for joining us.
Yeah, thanks, Leo.
After the break, Brexit in crisis. Theresa May's revised Brexit deal has been rejected. Where to next? Australian British Chamber of Commerce CEO David McCredie next.
Now, back to Ticky.
Welcome back again, and let's head to Britain now, where MPs have roundly rejected her revised Brexit deal. For some analysis on what to expect going forward, I spoke with the CEO of the Australian British Chamber of Commerce, David McCredie, in Canberra. David McCredie, thanks for joining us there. Well, Theresa May faced another loss, 149 votes. What was your reaction?
Well, to be honest, Ticky, once Geoffrey Cox, the Attorney General's independent legal advice came out late last night, our time, particularly point 19, the last of his points under which his signature is emblazoned across the page, it became fairly apparent that the sort of assurances that the Parliament had been seeking, in particularly the ERG and the DUP, weren't going to be met, and therefore the deal was unlikely to be passed.
It was an extraordinary vision this morning of a very croaky Prime Minister, nevertheless still on her feet and still, by all accounts, going to stick around.
Yeah, that's right. I mean, I've, like many, I'm sure, I've watched a lot of the Sky News coverage from the UK this morning, and basically every Tory MP has basically made it clear that leadership's not on the table at this stage, and we've got to remember that she's actually in a secure place in terms of that until December, in terms of her party being able to dislodge her from the leadership, thanks to the leadership ballot they held in December last year. So it will continue under her leadership for us until then, unless she decides otherwise.
David, she has actually offered, as I understand it, a free vote for MPs on whether a no deal should be taken off the table. And again, as I understand it, she will be voting for a no deal to be taken off the table.
I'm not 100% sure whether she's made it clear that that's the case. Certainly, in her statement directly following the vote, she made it very clear that there would be a free vote, and she did indicate that she, along with other members on her side of the House, because the free vote's only on her side, she can only control her own party, yes, or conduct her own party in that way. So she said she, like others, would have to examine themselves very deeply and decide which way they were going to vote. I don't think she gave a clear indication that she would vote for no deal.
And there seems to be added confusion with possibly another bill put up to vote for, and questions about whether politicians will be voting for a no deal you know, to be the permanent situation. So under any scenario going forward, no deal will never be on the table. I mean, one would think if that were the case, there would be a lot of reaction at the grassroots around Britain.
Yeah, and I'm not sure, to be honest, that that sort of deal has any sort of numbers in the House. Nigel Evans, who's the Secretary of the 1922 Committee, in an interview earlier today, made it clear that he didn't believe that there were any or many no deal as a long-term solution advocates. Certainly there were plenty who didn't like this particular deal. There were some who would prefer no deal to this deal. But the number of participants in the House that would vote for no deal as an ongoing solution, I think, are very few. So I'm not really sure. I mean, a lot of this is about perception. A lot of this is being played out in various different angles, partly around, well, how do we get to a deal that we can support, partly around, you know, Jeremy Corbyn's been very clear that he wants no deal taken off the table. I think part of the challenge here is that there's two very different discussions going on. There's the domestic politics piece, which Jeremy Corbyn is basically trying to unseat the government. That's what any good opposition leader tries to do, but not necessarily doing that in a way which is useful in terms of the national crisis and the external conversation that the UK is needing to have with the European Union and indeed with the world about how they're going to move forward. So there's this big conflict there about what the actual aims are of the participants, be that Jeremy Corbyn, be that the SNP, the DUP, or indeed elements within the Tory party itself, the ERG and others.
So explain to us how this week is going to pan out, will you?
Certainly. So after today's vote, the Prime Minister made it very clear that what she'd suggested a fortnight ago would be the methodology the government will take over the next couple of days. She announced that the tariffs and the various arrangements for A no-deal Brexit would be put on the table tomorrow for MPs to examine and be familiar with before a vote tomorrow night to decide on whether the UK would accept no deal as an option, as the outcome at this stage. As I said earlier, I'm not sure that there's the numbers to support no deal as a long-term proposition, but I think there is an interesting piece around whether we support keeping no deal on the table because we need that for negotiating power with the EU. So there's a conversation there that I think will be very interesting to follow over the next 24 hours, or slightly less than. The vote will happen tomorrow morning our time. And then a further vote, assuming that a deal is required from that vote, then there'll be an additional vote, the third vote on Thursday or on Friday morning our time, where the UK would potentially seek an extension to the Article 50 arrangements, basically kick the can down the road, potentially for a few months.
Why would Europe? And that's all for the show tonight. Tomorrow night, Australia-China Business Council CEO John Brumby. Thanks for your company.